So I'm going to talk to you about today the project House Price Beliefs and Mortgage Leverage Choice. And so this paper really nicely ties together a few of the themes we already saw. House price beliefs, during our last session, we talked about beliefs and how beliefs shape economic decision making and what influences beliefs. So we could have presented this paper last week as well, but because it is about mortgage leverage choice and ultimately about the mortgage decision, we have it here. It also has a touching point on the session on P effects we saw a while ago, because as you see in the empirical part, we're going to use peer influence as our identifier variation. With that said, let me jump in and actually tell you about what the paper does. So mortgage leverage choice is really central for macroeconomic activity. Especially we can think of really the most recent financial crisis, the 2008 financial crisis, as being driven by mortgage leverage choices in the run-up of the crisis and then the subsequent collapse when people decided to default on this. And so there's this narrative of the 2008 crisis that argues that in the run-up, people were overly optimistic about home prices and they took on high leverage, and that contributed to that kind of bubble idea. So what we want to do in this paper is actually take a step back and say, well, does the story make sense? Is it plausible? How do beliefs actually affect the house prices affect leverage decisions of households? Does the simple story hold? So in the paper, what we're doing is we first present a parsimonious model to relate home buyers' beliefs to mortgage leverage choices. The main result of that model is that there's actually an ambiguous relationship between optimism and leverage. Let me give you the intuition. In the model, as well as in a class of models that look at this, buyers' beliefs affect leverage choices through two channels. The first channel is the perceived attractiveness of the investment. Here, optimistic home buyers want to purchase more of an asset, and that means they have to increase leverage, they have to lever up to be able to afford more of the asset to be able to pay for it. But there's a second channel, which we're going to call the perceived down payment protection. And so according to this channel, optimists, because they think house prices will go up, actually expect that they will repay their mortgage in more possible states of the world, because they just don't think that it is very likely that house prices will fall and they will default on their mortgage. But that also means that they think borrowing money is more expensive because there are more states of the world where they're going to repay. And so they rather want to use their own resources, which they feel they will keep, rather than the bank's resources, which are expensive to borrow, to invest. On the other hand, more pessimistic home buyers believe that they will default more often. And if they believe that they will default more often, they want to protect their own money. They would rather want to use the lender's resources to invest, which means that all else equal, they will take higher leverage, less of their own money. So now the first channel, the perceived attractiveness of the investment, requires that optimistic home buyers want to buy more of an asset, and that's why they increase leverage. That is, it requires that homeowners adjust the size of their investment based on the beliefs about how house prices will develop. And so what we will show in the paper is that this willingness or ability to actually adjust property size in response to beliefs about house price changes is the key parameter which tells us which of these two channels will dominate. If home buyers are very sensitive in the size of their investment to their expectations about the returns. That is, when they're more optimistic, they buy bigger homes. When they're less optimistic, they buy smaller homes. Then it turns out that the first channel dominates, and more optimistic home buyers will have higher leverage. However, if the sensitivity is low, or in other words, there are many other factors that determine or pin down house size. So if the size of the investment, the size of the house people buy doesn't react very much to what they believe about house prices going forward, then the second channel will dominate. And that means that more optimistic home buyers will have lower leverage because they want to invest more of their own money into the house. So what could be these factors that restrict the adjustment to the exposure of the asset? Well, we're looking at owner-occupied housing. And so we think that for owner-occupied housing, homes that people live themselves in, there are many factors that affect what size home they want to buy, in addition to what they think about the house as an investment, as a financial investment. There's family size. If you have 3 kids, you probably don't want to live in a studio. There's neighborhoods. In some neighborhoods, you can only get certain size homes, or you can just get, bigger homes or apartments, depending on what you're looking at. You might want to be closer to certain schools, to your work, and that restricts your neighborhoods and the available home sizes in these neighborhoods. In short, we think there's many other reasons that factor into the size of the home you're buying, not just what you think of the home as a financial investment. So what we do after we show this theoretically in the model, we're going to test this empirically. We're going to test empirically the cross-sectional relationship between homeowner beliefs and the leverage choice that they're taking, because we call that theoretically. We're going to show you it's going to be ambiguous. We're going to do this, and I'll tell you much more about the details when we get there, using the house price beliefs of people's friends, which is what we used in our earlier paper as a shifter for homebuyer beliefs, to test that relationship empirically. What we're going to find is that more optimistic households choose lower leverage, consistent with the idea that there are many other factors that affect leverage choice other than just the beliefs about the house prices going forward. Okay, let me tell you about the model. So the model has 2 dates, and borrowers or homeowners, they have preferences over current consumption and the future value of their home. So in the first period, homeowners choose their initial consumption, their house size, and they choose how to finance the leverage of their home. The way they finance their houses is with collateralized non-recourse loans. So for the purpose of this talk, I'm going to assume that there's no cost to default. In the paper, we show that these the basic intuition carries through when we have more complicated forms of actually default costs. Importantly, because we want to look at how differences in beliefs affect the house financing decision, people, though individuals, will differ along what they think will happen to house prices. And so each individual has a distribution over future possible house price changes, and they can differ along these distributions. So you can see this here in the F, that's a distribution for each individual of the probabilities she assigns to all of the possible house price changes. So then what do homeowners do? Well, homeowners choose current consumption, housing, and leverage to solve their, to maximize current utility, subject to very standard budget constraint. Lenders are the other side of that leverage decision, and we assume that the LTV ratio is determined, or the schedule, that's kind of the possible LTV choices that the homeowner faces, are determined by a competitive risk-neutral lender. Importantly, the schedule, the LTV schedule that the lender offers, depends only on the lender's own beliefs. It doesn't depend on the homeowner's beliefs. Okay, so the lender kind of sets its schedule based on what they think will happen, and if someone is more optimistic, they're not going to get more advantageous terms. So everyone faces the same schedule. The last thing we have in the model is this constraint on the housing size. So what the way we kind of capture this is by saying that people have a minimum property size that's dictated maybe by their family size. And this is a shorthand of capturing other consumption forces that determine property size that you might have in there. This very kind of straightforward way and just having a minimum house size is nice for the purpose of illustrating the inside of the model, because it allows us to look at what happens if the constraint is binding versus what happens if the constraint is slack. But we explore more kind of continuous forms also in the paper. Okay, so when we look at the optimality conditions, we see two ways that beliefs enter into those. Through the expected return of the investment and through the marginal cost of borrowing and saving. So first of all, if individuals take a higher leverage, then they can buy a bigger house, and conditional on repaying, they have a higher payout from that bigger house in the second period. That's the expected return to the investment. The marginal cost of borrowing and saving, of course, is that if you take a bigger mortgage, you have to pay back that bigger mortgage, and so there's going to be costs to that. Let's first look at the case where this housing constraint is slack, where households are not pinned down in the house size by their constraint, but where they kind of have an interior optimum. So in that case, it turns out that leverage is pinned down by the following equation. And the beliefs about house prices enters in this conditional expectation of house price growth. What does this mean? It means that in this case, someone is more optimistic than someone else if they expect higher house price growth conditional on repaying their loan. Basically, people differ in their optimism if conditional on assuming that they're not going to default on their mortgage, expect higher house price growth. So here we're going to call someone more optimistic in terms of a truncated expectation dominance. And what this means is that the expected return force here is bigger than the marginal cost of borrowing force, and really people disagree about the return of the investment of the upside conditional on repaying. On the other hand, if we take the housing constraint as binding, so now the housing target constraint is not slack, it's binding, and so house size is determined by that constraint. It's pinned down by other considerations such as family size. So if housing size is no longer variable, leverage is pinned down by this equation here, and you can see how beliefs enter in the distribution of this kind of distribution of expectations over house price choices, and specifically here the repayment. So here we're going to call someone more optimistic than someone else if they think that they are more likely to repay their mortgage. And this concept ultimately boils down to just being first order stochastic dominance. If one borrower's belief distribution first order stochastically dominates another one's, that means they're more optimistic in this sense, and they really disagree about the probability of repayment. So the upside doesn't really factor in here. It's really the disagreement. How likely is it that you're going to repay and not default? If you think it is more likely, you're going to be considered more optimistic in this case. So now we have these two conditions for when you're more optimistic and whether you will take higher or lower leverage in both the variable as well as the fixed house size scenario. The issue with taking this now to the data and trying to see what happens is that these are not the same concepts, and neither implies the other one. So we have two things that we can do. The first one is find a concept that implies optimism in both of these scenarios, rank home buyers by this measure, and then see whether more optimistic home buyers take higher or lower leverage. We can do this with what turns out to be hazard rate stochastic dominance. The issue here is that this does not give us a complete ordering. In fact, if we were going to try this for our data, we couldn't rank most pairs of homeowners. We couldn't say who is more optimistic in both scenarios. And that's problematic because how are we going to then take this to the data and test it? So an alternative approach is to make a parametric assumption of like what shape these distributions, these belief distributions over future house prices take, and then we can rank them according to this distribution. Here, what we're going to do is we're going to assume that a distribution of beliefs over future house price changes is normal. For house price changes, it's actually a kind of reasonable assumption. If you look at prior house price changes in the data, they are unimodal and they are symmetric. And so putting a normal on top of that seems to okay fit with the data. And so the key advantages are that it allows us to completely order everyone in our data set. We're also going to get some additional prediction. Of course, the big downside is that it requires a distributional assumption. But if we're willing to make that assumption, then we get these parametric predictions where if someone has a higher mean in their distribution, that means that both in the variable as well as in the fixed house price scenario, the person with the higher mean is considered to be more optimistic. If you're in the variable house price scenario, that would imply that this person chooses a higher loan to value. If we're in the fixed house price scenario, this optimism would imply that this person chooses a lower loan to value. So now this is what we can take to the data. This is where we can say, well, if we want to know which scenario we are, let's just go to the data, estimate whether someone who is more optimistic in this measure is taking a higher or a lower loan to value ratio when they're buying homes. And that tells us what scenario is a better fit to what we observe in real life. Okay, so let's take it to the data. How would we do this? Well, to do this, the ideal experiment would be if we could have two similar individuals buying a house in the same place at the same time, but who have different beliefs. The problem with that is that we don't actually measure beliefs well. We don't have belief distributions elicited for a wide range of individuals. But even if we had, we might be worried that there are things that might affect both the beliefs of an individual as well as affecting her leverage choice. For instance, you might be worried that someone who's just more successful at work, who had things go really their way very successfully, that these people might just be more optimistic because they've seen things are going well. I'm successful, everything goes my way, and that's great. But they also might just have more money. Okay, and so if that's the case, then if we see them taking a lower leverage, it might be because of more optimism, or it might be because these people are just richer and they're expecting a higher income growth going forward. So what we're going to do, we're going to use the belief shifters that we used in our earlier paper. So in that paper, we showed that house price experiences of geographically distant friends affect the beliefs about future house price changes of the individual. So we have something where if you have better experiences in your social network of your friends, you tend to be more optimistic locally. We also show in that paper that these shifters are largely orthogonal to other home buyer characteristics and to other factors that could be influencing the leverage decision. So we are going to use those as a shifter of beliefs, and then if we see those affecting the ultimate leverage choice, we're going to argue that this is coming through the effect on beliefs. So we're going to do this in two steps. In the first step, we're going to show in a survey that indeed these friend experiences affect beliefs about home prices going forward. Relative to our earlier work, we're now going to show that the distribution of friend experiences affects the distribution of beliefs. Then in the second step, we are going to regress these friend experiences on leverage, and we're going to argue that the effect is going to come solely through the effect on beliefs. Before we jump in, let me briefly tell you about the data. So the data is an anonymized snapshot of the Facebook social graph. We observe the number of friends in each county that an individual has. On average, an individual has about 400 friendships links spread over more than 50 counties. So there's a wide geographic variation. The second piece of data is the belief survey that I will tell you more about in just like a few slides. And then finally, the third data set is public records housing transaction data, which we use to look at the actual leverage choices. In this data set, we have 1.35 million housing transactions in almost 3,000 zip codes and in 33 states. What we observe are some property characteristics, the transaction price, and mortgage information. This is how we get the LTV ratio. And we have these transactions between 2008 and 2014. One thing I want to be very straightforward about is that we can only match buyers of owner-occupied properties. So everyone here will be buying a home that they themselves live in. So these are not landlords or rental properties. That might be interesting for other reasons, but this is owner-occupied housing. Okay, let me tell you about how we construct the belief shifters. So first we construct the average house price change in the friendship network over the past 2 years. There are two components that go into this. The first one is where someone has friends. So in which counties across the country this person's friends are located. And the second input is what house prices did in those areas. Let's first look at where someone has friends. You see here one Facebook user is located in LA and where this person has friends. And you can see that they have friends in the greater LA Southern California area, but they also have this cluster of friends here in North Carolina. This is another LA resident. And again, we see this kind of concentration on the West Coast with some friends up in Seattle and Oregon, but also this cluster of friends in Minnesota. And so this is the first part of the variation, is where does someone have friends? The second part of the variation is how did house prices do in these areas? And during this time horizon, there was a wide variety of house price changes over the this period across the country. So some areas had basically very, very stable house prices, house price changes around 0, but in other parts of the country, they were going up by 20, 10, 20%. And so while the share of friends in each location is clearly not an exogenous shifter, this interaction with house prices, we argue, is. Because the same person with the same friends in the same location will sometimes see higher house price scores in this location than in other locations. Think about it. Someone with friends in Arizona versus someone with friends in Indiana. In Indiana, house prices were pretty stable over this entire time horizon. Whereas in Arizona, they first had a big boom, and so the person with friends in Arizona would have had higher house price experience early on, but then during the bust, that would have been lower. So they will actually change their ranking over time, even though friends are going to stay the same. And so this is these friend experiences that we're going to measure. So now let's first check whether these friend experiences truly shift beliefs about house prices going forward. We're going to look at a survey that was run on the Facebook newsfeed in April 2017. We have a little more than 400 respondents. They all live in LA in a few zip codes, so we can control for where they actually live, to control for what they might have seen locally. And they look actually quite representative of the demographic of the zip code where they're coming from. They ask a few questions. They ask how often they talk to their friends about housing. And then the key for us is this elicitation of the distribution of beliefs, where they're going to assign values to all of these buckets of possible house price changes, which allows us to measure the distribution and then compute a mean and variance. So now we relate these features of the belief distribution, specifically the mean and the standard deviation, to the friend experiences of the individual. And what you can see in the first two columns is that someone who has more positive friend experiences on average tends to be more optimistic about local real estate in LA. We also find that people who have a higher dispersion in friend experiences, this are the second two columns, where there's a wider variety of more different friend experiences in their network, they also give a wider distribution about local LA house prices. And so that confirms to us that the mean of the friend experiences distribution shifts the mean of an individual's own beliefs, and the standard deviation does the same to the standard deviation. Okay, with that established, we're now going to look at the loan-to-value ratio. Okay. So our dependent variable is loan-to-value ratio, and we're going to regress that on the two moments of the friend house price distribution, the average house price and the standard deviation, and some controls and fixed effects. So what are these? We control for the purchase month by county by lender fixed effect. So this is really to ensure that we are comparing borrowers who face the same local housing market and who also face the same local credit conditions, because they're both buying the same month in the same location and they're getting their mortgage from the same lender. So they're kind of facing this identical menu of LTV choices that we assumed in the model. We also control for other things that might independently affect the loan-to-value ratio, such as these borrower characteristics, such as age, education, income, and household size. Okay, here's what we see. 1 percentage point increase in the friend house price experience in the past 2 years increases the loan-to-value ratio, decreases the loan-to-value ratio by 0.08 percentage points. If you compare this with the with our estimate earlier that we had and how much it shifts the own house price distribution, that means that we get 27 basis point change in the LTV from a 1 percentage point change in expected house price growth. Importantly, you see in these first two columns that we have this negative effect of the friend average house price experience. So people whose friends had more positive experiences, who we therefore think are more optimistic themselves, they actually take lower leverage. This is consistent with the prediction of the scenario where we had strong constraints on housing size, where people are not very sensitive to their beliefs when choosing the size of their home. We also see, as predicted, that a higher standard deviation in the friend distribution, and therefore we think in the own distribution of expected future house prices, increases mortgage leverage choice. But this is the case in both scenarios. So while this confirms that the model has the right prediction, it doesn't allow us to distinguish which of these two different scenarios we're in. So now we're going to go and cut the data by a few more things to see whether this is really the story, what's happening here, to see just additional predictions. So the first additional prediction is that if you think that this is coming through the down payment protection channel, where people are choosing to invest the lender's resources because they're less optimistic and they want to kind of ensure their own money, and so they rather invest the lender's resources when they're more pessimistic, but their own money when they're more optimistic. In states that have recourse loans, where banks can go after borrowers even if the house price falls to collect that money, this down payment protection is a lot less valuable. It's just not happening to the same degree, and we would think that this channel should be dampened in recourse states. And this is exactly what you see here. In recourse states, the negative effect of this positive house price distribution, the fact that more optimistic people take lower leverage, is dampened, and really the effect is coming from the non-recourse states. The second prediction in this case is this idea that this whole agreement, this whole down payment protection channel, where you're rather invest the lender's resources because you're worried that you might default, That should be a lot less important if house price expectations are higher across the board. So for individuals who expect pretty high house price increases anyways, in some sense where you expect an increase of 10, 15, or 20%, doesn't really matter. No matter what, everyone agrees you will mostly repay. That should mean that there's little disagreement about the likelihood of repayment, and our channel should be dampened. And we see this in the data where in column 4, we cut by or we interact by how optimistic the level of the beliefs are. And we see that higher average beliefs or measured through the friend experiences dampen the channel. The same is true when we cut by whether we're doing the recovery or kind of the bust following the crisis. During the recovery, when house prices are higher overall, the channel is again dampened. All consistent with this idea that is coming through the mechanism of the down payment protection force. Finally, the last column is looking at the home ownership rate. And what we see here is that this idea that more positive house price experiences in the friendship network lead to lower leverage is particularly strong in areas where there is a high home ownership rate. What that means is in those areas, if you have a high home ownership rate, those tend to be areas where it is hard to rent. And so even people, home owners or individuals who are very pessimistic and who would normally try to opt out of the owner market and just rent a house are somewhat more likely to actually be homeowners because they can't find a suitable rental house. And so you're going to have a wider distribution of possible beliefs among those homeowners because it's harder for the more pessimistic individuals to drop out and become renters. Again, that's consistent with this idea that it's coming through the beliefs about the down payment protection force. Okay, so then we also do a lot of robustness checks and try to rule out alternative channels. I don't have time to go over all of them, but I want to mention what I think is maybe the one that people are most worried about, that there might be something where this is driven through wealth or bequest effects. So when you saw those maps earlier on, it's plausible that for many people, the friends that they have outside of their current location, these are people in their hometown. And so if this is your family, if house prices in your hometown might be going up, it might be that your parents who have a house in your hometown become wealthier and they're more able or willing to help you out with your house through giving you cash transfers or through kind of you just expecting a higher bequest. We don't think that this is what's going on, partially because we find that the same effect across different networks. If you just look at the employer or college or isolate the family, we get very similar effects where we think, well, you're much more likely to get a transfer from your family than you are from your employer or like your work colleagues. We can also use out of state instead of just out of county friends as instruments. And we also show that this is not driven by common shocks. We can actually control for the income changes where the friends live. So if there is just a general increase in wealth and incomes in these areas, and we can look at people who work in professions that are not geographically clustered, where it is implausible that a shock to their industry drives house price changes where they have friends. We can also control for the friend foreclosure rate in the network to argue that this is not coming through learning about how easy or difficult foreclosure is. Finally, we have a bunch of ancillary evidence in the paper. And so I think what a lot of people struggled with when we presented this paper was the idea that this mechanism seems to work in a model, but I think a lot of people had trouble thinking through whether the average person would really think like this. Okay? And so the part of the ancillary evidence that we wanted to highlight was an additional survey that we ran separately on an online platform where we gave people scenarios, kind of a more pessimistic versus a more optimistic scenario, and then asked them what they would advise someone in these scenarios to take as leverage. And then we asked them why they recommended this. Okay? And you can see that people say things like, well, the house may be worth less and I would rather have cash on hand than tied up in the house. That's exactly this channel that we have in mind, that our model has in mind. And so many of the respondents mentioned things along these lines, making it plausible that people really think like that, because these people haven't seen our paper. These are just respondents to a survey, and they argue in that same way. It's not just some random survey respondents. We also saw advice along these lines on many financial advice websites. So this is from a financial advisor who's actually Barron's #1 ranked advisor. So presumably a lot of people follow his writings and take his advice seriously. And so what he says, you might be worried that your home's value will fall. Yep, that's exactly it. This is a more pessimistic person worried about falling house prices. And then what he says is down here is simply get a new mortgage and pull the equity out of the house. In other words, get a higher loan to value ratio. And so what that means is that he says, well, more pessimistic people should get a higher loan to value ratio. On the flip side, more optimistic people will get a lower loan to value ratio. This is exactly what we find empirically, what people seem to be doing. Okay, so let me summarize. In this paper, we first show theoretically that the effect of optimism on leverage is ambiguous, because housing has this dual role as a consumption and as an investment good. And the key parameter that determines in which direction it goes is how much households are willing to adjust their property size based on investment considerations. Importantly, if household size is influenced or pinned down by other considerations, in our example, family size, this goes through adjusting the leverage to, if you want to be more invested, you do that by financing a smaller portion rather than by levering up. We then showed empirically that, at least during this time horizon, more optimistic agents indeed take on lower leverage in the cross-section. And I think that's an important finding, because this means the story that people are kind of trying to push, that more optimistic homebuyers are going to lever up more and take out these bigger and bigger mortgages, at least for owner-occupiers who have other considerations for the size of home that they're buying, this is a little bit too simple. Okay? So optimism by homebuyers is not enough to generate an increase in aggregate leverage, not for owner-occupiers, and you need something else, such as credit supply shifters or kind of a relaxation in credit standards to get the aggregate effects that we saw in the data. The last thing I want to mention is that, as you've seen before, we now have a county level social network data available to share with other researchers, the social connectedness index. And you could construct many of these measures, not at the individual level, but basically at the county level, where you look at this house price experience or under experiences in these friend areas with this aggregate data that is available, and use that as shifters for whatever you might want to look at. Okay, and with that, I think I am out of time, and I already see Matteo there to probably take my spot.
Hey, let me. Sorry, I wanted to just add one thing to to the just to kind of as a thought. So one thing that what we realized was very helpful with this paper was that we were able to use this survey to really get at the mechanism, and I think this is something that that's actually quite unique and quite hard to do in other settings, and so I think it was kind of unusual that when we had the results, people said, well, we can see it in the model, and we kind of don't really have a great alternative interpretation in the data, of your empirical results, but I still sort of somehow don't believe it. And so, you know, what we ended up doing is to just run the survey and really just basically ask people in words to describe the you know, the specific process that they you know, that they went through, the specific thought process. And that was extremely helpful for us, because it you know, it allowed us to just provide extra evidence that really, you know, people are describing, to go through exactly the trade-off that the first order condition is sort of trying to you know, is trying to model. And so I think that was you know, I think that was really very helpful.
Yeah, I want to add one thing to that. I think this paper is really kind of one of those papers where the model and the empirics are so nicely tied to each other that they work. And the model by itself probably wouldn't have flown. The empirics by itself wouldn't have flown, but together they make a nice combination. And I think what Johannes just said is like, then we call it the ancillary evidence and the extra survey that just helps people believe that. And you saw this in Johannes's job market paper, where he also had these quotes. I think sometimes when you have, this is not a systematic analysis. No, this is not the evidence that you need to convince people, but it really, really helps to make people believe your results beyond the fact that they see it in the numbers. Sometimes if something is not intuitive to people, like, you need these types of things to make them realize that this is an important part in the world, and that real people think like that, and it is not just in your model. And so this is not a substitute, but this can be a very, very important complement to convince your paper. And I think, you know, I don't know if Johannes told you the story, but I think Johannes said in his job market paper, so one person who said, like, I can't see anything wrong in your analysis and in their model. That seems all right, but I just cannot get myself to believe that this is what people think. And so if this is your problem, this ancillary evidence kind of showing that you see this on financial advice websites, that people chat about it, that it shows up in the newspapers, is very, very helpful to convince people along these lines, conditional on you having also, you know, the model and the proper analysis.